Apple. We're talking about the most valuable company in the entire world. And they just posted what can really only be described as a record-breaking quarter. I mean, these are the kind of numbers most companies can literally only dream of. Yet, almost immediately after releasing these numbers, the stock got absolutely hammered. Welcome to The Explainer. Let's strip away all the market noise together, look directly at the data, and build a complete picture of exactly what is going on with Apple right now. So here's the ultimate market mystery we're diving into today. How on earth does a massive revenue beat, a quarter where almost every single metric totally exceeded expectations, somehow equal a sudden and violent 7% plunge in the stock price? When the world's biggest tech titan drops that much, that fast, it sends shockwaves through the entire market. But look, markets aren't irrational. They're just reacting to data that we might not be focusing on just yet. Okay, let's dive into this. We've got a really clear, data-driven framework to solve this. First, the earnings paradox. Second, the warning signs. Third, the analyst battle. Fourth, technical analysis. And finally, a final verdict for your strategy. Part 1, the earnings paradox, a quarter for the record books. All right, let's put on our financial detective hats for a second and examine the initial evidence. We really need to ground our entire narrative right here with this number. $109.4 billion. That was Apple's Q3 revenue. Just to put that into perspective, that's a June quarter record for the company, representing a massive 16.4% jump year over year. Think about the sheer scale required to grow a company of this size by over 16%. We're talking about adding the equivalent of a Fortune 500 company's entire annual revenue to their top line in just a single quarter. It is absolutely astronomical. And honestly, the deeper you look into these blowout metrics, the better it gets. Earnings per share didn't just inch up, it soared by 29% to $2.02. And the iPhone, the core engine of Apple's entire empire, it generated a staggering $54.3 billion, which is another June quarter record. By any traditional fundamental measure, these numbers show a business that is just absolutely firing on all cylinders. But what's really interesting is the internal shift happening beneath those headline numbers. Apple's services segment just hit a record $30.7 billion. That means services now make up 28% of Apple's total revenue. This isn't just a hardware company making phones and laptops anymore. A massive, highly profitable chunk of their money is coming straight from the ecosystem. Think the App Store, subscriptions, cloud storage, and digital content. But hey, the financials only tell part of the story, right? You've got to contrast that financial scale with their sheer reach. Apple has an active installed base of over 2 billion devices worldwide. This is what we call an economic moat. And frankly, it's a moat that very few competitors on the planet can even dream of touching. Once you're in that ecosystem, you rarely leave. So with all this incredible news, what went wrong? Moving on to part 2, the warning signs, uncovering the hidden motives. So here is the twist in our detective story. The past is great, for sure, but the stock market, it's always looking to the future. And that forward guidance miss is our smoking gun. Wall Street totally expected Apple's revenue growth for the next quarter to be around 12%, but Apple came out and guided for just 9 to 11%. On top of that, they warned of a sharp expected drop in Q4 gross margins, projecting 47 to 48%, which is down from 50.1% in Q3. And let me tell you, the market absolutely hates when growth slows, even by a tiny bit. But why the sudden drop in margins and growth? Well, listen to this specific, highly evocative quote from the earnings call. CEO Tim Cook pointed to severe supply constraints and surging memory chip costs, and he went so far as to describe it as a once-in-a-century flood. When the CEO of the most valuable company in the world uses language that dramatic to describe supply chain and cost headaches, Wall Street listens, and Wall Street gets very nervous. And then there was this massive red flag. We talked a minute ago about how amazing the services revenue was. But actually, scratch that. The total revenue was huge, but the growth rate of that services sector, it decelerated to below 10%. This is vital to understand because services is exactly where Apple's high-margin profits live. If hardware gets squeezed by supply chains, you really want services to pick up the slack. So when services growth slows down at the exact same time, investors just hit the sell button. All right, part 3, the analyst battle, where the expert witnesses take the stand. With all these conflicting signals floating around, Wall Street is entirely divided right now, and we need to weigh the expert testimony. And this brilliantly illustrates just how wide that divide really is. On the bear side, you have KeyBanc coming in with an underweight rating and a price target of $250. But on the bull side, you've got Morgan Stanley and 24/7 Wall Street with price targets way up between $360 and $375. Guys, that is a massive $125 gap between the smartest minds on Wall Street. It shows us that right now, market conviction is incredibly low. Let's break down the bear arguments first. KeyBanc's warnings are very specific here. They argue that Apple's premium pricing strategy is finally going to limit user growth, which makes that services slowdown we just talked about basically inevitable. They also point to canceled projects, like the rumored all-glass iPhone, as a glaring signal of innovation fatigue. You know, when a company famous for reinventing entire categories starts shelving ambitious hardware designs, consumers start to wonder if the era of groundbreaking form factors is just over. And finally, they argue the valuation is just too rich. Apple is trading at a 35 times forward price-to-earnings ratio, while the sector average is sitting at just 24. To the bears, it's just too expensive. But let's balance that perspective out with the bulls. The really optimistic view here is that Apple has a massive AI catalyst right on the horizon. With deals like Alibaba in China and a totally revamped Siri, they view Apple's ecosystem of over 2.5 billion devices as the ultimate frictionless AI rollout platform. Just think about it, an instant upgrade for billions of users overnight. For the bulls, that 29% EPS growth we saw earlier, that more than justifies the premium price tag. Yes, services growth slowed down a bit, but it certainly didn't collapse. So if you take all these clashing opinions and blend them together, you get a consensus price target of $328. That represents a pretty modest 7% upside from current levels. But keep in mind what we just looked at. That extremely wide range between the bulls and the bears makes this average a little bit deceptive. The market is very, very unsure of where this stock is heading next. Part 4. Technical Analysis. The Ground Truth. Look, when opinions get this polarized, we just strip them all away entirely and look at the cold, hard math of the trading chart. The stock is currently sitting at a really critical pivot point, right around $305. If it drops, your lines of support are at $304, then $300, and there's a major floor at $295. But if it climbs, it's going to face resistance at $308, $316, and finally $323. Right now, momentum indicators are entirely neutral. We are sitting squarely in a wait-and-see zone. And here's exactly how you trade that wait-and-see zone. The stock is currently coiling, kind of just building up energy. A break below that major $295 support totally confirms the downside and validates the bear case. But a break above that $323 resistance, that triggers a bullish run, potentially sending it straight to $330. Crossing either of these extreme thresholds will definitively dictate the next major move for the broader market. Finally, Part 5, the final verdict, your next move. Okay, so let's synthesize all this data into a clear, actionable resolution tailored specifically to you. The crucial point here is knowing exactly who you are as an investor. If you're a long-term investor, the data suggests a hold. The business is fundamentally strong, AI is a very real catalyst, and those billions of devices, they aren't going anywhere. Now, if you're a trader, you wait. Just wait for that clear technical break above 323 or below 295 before committing any capital. And if you're a fresh buyer looking to get in, dollar cost average. The valuation is high for sure, but it's not quite bubble territory, so just ease your way in. To kind of summarize the short-term reality of this stock, Apple is juggling astronomical expectations, severe supply chain headaches, and a market that is quite literally demanding perfection. Make no mistake, Apple is a generational company, but at a 35 times forward PE ratio, current valuations leave absolutely zero room for error. If they stumble, even slightly, the market will punish them, exactly like we just saw. Which leaves us with one final, vital question to consider. Is Apple still a generational hold for decades to come? Or has the market finally priced in just way too much perfection for them to sustain? I am super curious to know what you think. Drop your own price targets and your rationale down in the comments below. Thank you so much for joining me on this explainer. Stay focused and happy learning.